Hey everyone, welcome back to another podcast episode. So today is going to be a special and in-depth episode. Jenny is going to walk us through the 2021 guide to Colorado Springs real estate investing. So Jenny, glad to have you on here.
Same here. I'm glad to be here.
Yeah, so this is going to be a very data-heavy episode, and the goal with this is actually the chapter that Jenny wrote into the 2021 investing guide we publish every year. And our thought process here is every year we're going to publish a report every year, a state of the market report as to what's going on in the current market, trends we're seeing, current deals, opportunities, threats, and just a general overview of the market to be a great starting point. So we will give you the high level in this episode, but definitely check out the book or the show notes. We'll have the exact same chapter in the book on the blog as well. Check out the book or the blog for all the details, numbers, reference to their podcast episodes. This is going to be a meaty episode because we're going to talk about market trends, then go through a few deal analyses on single-family rentals, multifamily rentals, answer a common question of can you still burr in the Springs market, and then go through and talk about the type of reserves you need to hold in your properties, and then fix and flipping, and also fix and listing, and then finally house hacking. So Jenny, this will take us like 4 minutes to go through.
Yeah, we'll
maybe 40.
We'll speed right through it.
All right, so take it away.
All right, so just to kind of go into kind of the backbone for Colorado Springs. I've said this before, but just kind of reiterating that I'm a pretty strong believer in the economy. I think it's very strong. I think it's very diverse. So that lends itself really well to investing. Some of the main types of economics that we're looking at is one is the military and defense presence, of course, and then also tourism. And then lastly, we're getting a lot of tech firms in. So Amazon's making a big push down there. They're opening up a couple distribution centers. We have it's called Peak Innovation Park, I think is what it's called. It's a new facility that's going in near the airport as well. So it's a lot of huge development projects for different industries that are coming in. So I'm pretty excited to see where that goes.
And one of the things I always look for, I'm a keep it simple, stupid guy, is it's just things are either growing or shrinking.
Yep.
And the Springs, it's growing. Population is growing still, right?
Exactly. Yeah.
And industry and jobs are growing, right?
Exactly. Yeah.
And we just need more inventory to grow down there, right?
Yeah, that's
not to spoil
the
anything,
main thing
but
that's going on.
Yeah.
Yeah, and I'm kind of the person where, these companies spend millions of dollars in research of where they're going to put these new construction projects for them to enter to the city. So I'm just going to follow where they're going. I don't have that sort of capacity to do all this myself. It's kind of like the Starbucks model, buy where they're putting in Starbucks. So same thing for this. I've been telling a lot of our clients, focus on the airport side of things. I think that's where a lot is going to start growing.
So one of my analogies I use for Denver is just, like a rising tide lifts all ships. And, overall, I think, most of Denver, you invest anywhere, you're going to be happy in the next 10, 20 years. Mm-hmm. Is that a similar train of thought for the Springs? Obviously, I think the Springs is growing. Is that a similar thought? Are there other pockets you hey, that we should see higher growth in these areas? How would you quantify that down the Springs?
That's a good question because I find myself telling most people that say, hey, what do you think about this? I always have something good to say about whatever area that property is in because, to keep things simple, the whole city is experiencing a ton of growth. So you're not going to go wrong, in my opinion, investing down here. There are probably some areas that are more poised for stronger appreciation over the next couple of years, and I've been kind of helping people on my best guess as to where that might be. But I think all around there's growth happening circumference for the entire city. So
okay, and then any areas in particular that you generally tell people to stay away from or avoid?
No, I don't think so.
Okay.
Nope. Mm-mm. So We have a chart here that is describing the growth. And I know that everyone who's been listening to our monthlies knows that I'm a broken record. We have no inventory and prices are jumping up. So they're basically just referencing that the historical rate of appreciation is about 5 to 6% per year. As of third quarter last year, we were up 16% on single family homes, and I believe that we ended at 18% by the end of the year. And I'm very curious to see what Q1 2021 ends up being, because I would imagine it's going to be even higher than that. Yeah.
And does that scare you? Because I mean, you're an investor yourself. You're a buy and hold. Does that scare you and say, hey, the market's so hot, I should sit out for a bit? Like, how should an investor, whether they're a brand new investor or they've got already existing portfolio, how do you interpret that to investing recommendations?
So great question. I think if I were a little bit more novice, I would be scared. But having been in this for 5 years, I feel as if the reasoning behind the price jumps that we've been seeing are sound to me. So without my crystal ball, I invested, I bought 2 properties in January. So I'm still investing down there, even though the prices are a lot higher than what I've previously bought properties for. The numbers still work. I'm still making a really good return on these properties. I am a firm believer that they're going to continue to grow in value and cash flow. So as long as it meets your investing criteria, I wouldn't try to time the market. I wouldn't try to guess what's going to happen 6 months from now. We don't know. If it works for you today, you should act on it. That's kind of my thought for that.
Okay, great.
And then just going down inventory, same old story. This one ended Q3 last year at 900 units. It's a bit of a different story now. I think we ended January or February with 400 units or something, something
so
wild.
So inventory is compressed even more since this.
It is, yeah. It's a free-for-all. It's been extremely competitive. The offers that we've been seeing have had huge appraisal gaps, huge price jumps from their listed price. People are just, clamoring for properties. So it's very interesting. I've never seen anything like it before. And then just for context, a balanced market is 4 to 6 months of inventory. End of Q3 2020, we're at 0.7 months of inventory.
And probably in the first part of this year so far, you're at, I think it was like 0.2, 0.3, if I remember from our monthly podcast.
Yeah, something really small.
Yeah. So, I mean, we're talking 0.2, 0.3, 0.2, 0.3, and a balanced market is 4 to 6 months.
Yes.
So it is a huge discrepancy there.
Yes. And I think, if anyone can tell into the future, I'd be curious to see at what point are we ever going to be balanced or even close to balanced. It's just the sellers have such an upper hand right now. It's very interesting. And I know we've talked about it before, but if you own a home in this market and you're considering what the best strategy is in terms of pivoting your equity, I think that if selling it is definitely a contender at this point, 1031 it into something bigger and better, I think, because you will have no issue getting that property sold.
And since you have the months of inventory up here, this slide up here we're looking at, do you have any data on like in your guide here on the foreclosures that Colorado has? Have you? I don't think you do. Because let's talk. I mean, because we've talked about with Joe Massey about that, and even if those foreclosures from the forbearances happen, which will not going to be a whole lot, do you think that's going to move the needle on the inventory?
I don't. I have really enjoyed his perspective on that, and I feel as if it's probably going to be the same story down Colorado Springs. Yep. And then even showings have seen a huge uptick. We're looking at 11 showings per listing at the end of Q3. And then I believe that this year is even, Lon had to skew his graph a little bit to fit the plot on here.
Because it was up in the 18, 19 range, right?
Yeah, it was just a tiny bit below Denver's showings per unit. And the reason is the same story. It's just that there's not enough inventory. So all those shoppers that are looking have to see the same home. as other shoppers.
And so the last couple years, I mean, we're recording this right in February timeframe, or I guess, February, March timeframe now. And so a lot of times in this time of the year on seasonality, Springs has been between 10 and 12 showings per property the last, 4 years. Now going into 2021, we're right around 18. So that is going from 10 to 12 to 18. So that is a big increase. And so that is just kind of showing us what a big increase that is. And I've heard stories from you, Jenny, and Leah down there. Just, hey, sometimes you schedule a showing and you're literally in line waiting out the door, right?
Yeah, I felt like I'm in Disney World or something. There's a queuing system where everyone's and their agent is just kind of spread out throughout the the yard and the driveway and the sidewalks, just waiting their turn to go in.
Can't you buy a fast pass and get to the front of the line?
Right, exactly. Maybe if you offer enough, you can. Yeah, it's a sight for sure. So, yeah, just kind of putting some dollars behind the crunch that we're seeing. The median sales price in El Paso County in June of 2020 was $360,000, which, as we mentioned, it was in the low 300s a year prior to that. So it's a really big jump. But it's interesting, though, because I think for many buyers, it's the same affordability perspective because interest rates are so much lower than they were a year before then. So you can afford a higher priced home for the same monthly payment. So I think that is kind of helping push things up as well. And then just something that my personal perspective, if we're looking at the median price being $360K to purchase a property, I advised looking about $1,600 a month in rent. And the reason for that is because if you were to kind of back into what a tenant could afford, if we're looking at $60K being the average household income, so that comes to about $5,000 a month divided by the 3 times rent rule. We're at about $1,600. So that's kind of where I came up with that.
It's a good way to look at it.
Yeah. And I'll have to look into it because I heard that the median household income for Colorado Springs jumped up. So maybe I might be revising this rule a little bit. So,
but I mean, that's not a hard and fast rule, right? I mean, something you buy, hey, I can rent this for $1,800. You don't kill it because of that, right?
Absolutely not. You just have to realize that your tenant pool is just a tiny bit lower, and that's it. Yeah.
So I think the townhouse you bought, what'd you rent that for?
$1,700.
So above your $1,600 mark?
Yep, exactly. So, and I was totally fine with it. So we had a little bit less inquiries, but we got a solid tenant within a week. So I would still call that pretty good.
Oh yeah.
And another thing that we've been noticing is that the rent prices are increasing at a faster rate than the 3% national average. We're averaging about 4% year over year. And then home values are increasing at an even faster rate. So 4% per year is the national average for that. We're at about 5 to 6 historical. As I just mentioned, it was 16% as of Q3 last year. So that's a pretty big jump. So that's, I think, what's causing a little bit of it being a little bit more difficult to find a cash flowing rental property is because those rents just aren't jumping at that same price that the purchase price is. And I have you can probably look on the show notes. I have a little chart showing if you were to buy a home and hold it for 5 years, if the rent were to grow at the same rate that we just mentioned, the 4%, and then if the value of the property were to grow at that 7% average, how much longer it would take if you were to wait to buy a property. So in terms of gross rent multiplier. So
I'm going to say, this was a side note when you mentioned the show notes. I want to, something that we're starting to do with the podcast now is we are upping our YouTube game as well. So since, a podcast like this, another one, since there's a lot of data and charts, you can listen to it, read the blog post, or if you want to, go to the YouTube channel, and we have all the charts up here while we're talking about it as well.
All right. So going into our first subtopic, single-family rental property investing.
I got one more question on trends for you before we move on to the next section.
Absolutely.
So So we talked about the general market right now as far as the way things are going. Are there any major red flags on the horizon from data that give you pause or consideration in what we're going through right now between the market conditions and, of course, COVID? Anything that's concerning you right now?
No, I'm not really concerned about much. And I think a lot of that has to do with my thoughts on reserves and contingencies, which we'll go into as well. But that in congruence with just the market as it is, I'm feeling pretty positive about it going forward for this year for sure.
Great.
Yeah.
Thank you.
Mm-hmm. All right. So single family rental property investing. I'm a little partial to it. It is probably my favorite niche. So, so we are including within single family rentals, condos, townhomes, and single family homes. So that's going to all be lumped in within single family rentals. So just kind of going into what we mentioned earlier, just we're seeing huge growth in median sales price. We've already talked about that. Again, it's stronger than the national average, which I think is also a good metric to compare it to as well. But going into more specifics in terms of rent trends, it's kind of interesting that there was a report that came out from the Apartment Association of Southern Colorado that said buildings with 9 to 50 units had the highest vacancy rates at just shy of 6%. And then buildings with 0 to 8 units had the lowest vacancy rate of 0%.
Which is almost unbelievable.
Yeah. Yeah. So if you're in a small apartment building or a single family home, you can basically have one person leave and one person come the next day to fill that vacancy if you operate in that manner. And yeah, I realize I have a very, very small sample of the total population, but that's the same thing that we've been seeing for our single family homes. It's just very, very high demand still for rental. And then, yeah, so another thing that's compounding that impact is that only 11 new apartment units were added to the inventory levels in Q2 of 2020.
Units or buildings?
Units.
So like 11 places to rent.
Yes, in terms of apartment complexes. So
we got the variety out there. Right?
Yeah.
Jeez, that is horrible.
Yeah. So I if I had to guess, I would imagine that developers are probably going to look to mitigate this soon. At least I would if I was in that scene. I think that would be a very good opportunity. And then another thing is that during COVID, only 5% of renters in Colorado Springs were delinquent and making rent payments. So that's pretty good, I think.
Yeah, I mean, that's not huge off of just normal times either.
Yeah, very true. So then just going into underwriting Colorado Springs rental properties, I know this is something that you're pretty passionate about, the 1% rule.
I love the 1% rule.
I know back in the day, 5 years ago, you could get pretty darn close to 1% rule. Now you cannot. It's like the 0.5% rule. And that's pretty decent at that point. So just something to consider. And I think that yes, it's a good metric. It makes sense as to, why that metric is popular and everything. But something to consider for Colorado Springs is that it offers a lot of benefits that you're not necessarily going to see in general for most properties that meet the 1% rule. Because if you're going to meet the 1% rule, it's mostly a cash flowing opportunity. Whereas in Colorado Springs, we've kind of shifted away from cash flow more so on long-term appreciation, wealth building, debt pay down, all that good stuff. And also, I feel as if it's important to note that we have really low property taxes that goes into your expenses. Right now, the vacancy rate is extremely low. That goes into your revenue. So I think that those features are really important to note that, even though it doesn't meet the 1% rule, it still has a lot going for it.
So you mentioned property taxes. So I got a curveball I'm going to put you on the spot with.
Okay.
What about the repealing of the Gallagher Amendment last year, which I've read some very high level stuff on what it'll do, and that's not going to take effect until really we get until 2022. If I do my math right. Any idea how much that might increase property tax? Have you read? Because I've seen some various articles floating around for Denver, but I've seen nothing for the Springs yet. Have you seen any?
I have not seen any specifics. I've only basically read the cursory, content for that as well. So I'm not sure. So that's a good point. I'm not really sure.
So if anyone in Colorado Springs is an expert on that, please reach out so you can educate us and other people out there in the Springs.
It'd be very helpful. I do know that my property taxes this year went up only a tiny bit from the previous assessment. So I was pretty happy with that. And then 50% rule. This is just another general rule that you'll see out there on the internet. 50% of your rental income has to go towards operating costs. We see about 30% going towards operating costs in this area, same as Denver. So for those of you that are consuming this visually, we have a chart up here that just kind of has some of the inputs that we do for our cursory analyses. As Chris always says, does it pass the sniff test? Pop these numbers in, see if it works, and then if it works, and if we're able to get it under contract, at that point we would use that as the opportunity to do a deep dive to get a more clear sense of what your figures are going to look like. So this is a condo example. We can go into each one if... Yeah,
let's just do a quick like high level, just kind of the rough numbers, not a detail, because I know some of these we've actually done in-depth podcast on.
Yes.
And I don't know if you recall which ones we've done podcasts on, but we'll give you the quick high level, just some rough numbers and cap rates so you guys get a feel for down payments, operating costs, cash flow, all that stuff. And then in the show notes, we will link to the actual episode if we have more details.
Yeah. So we actually, I believe that this was on the single family rental podcast in detail. So just kind of skipping to the details that you mentioned, just kind of going across the top. We have the condo example, purchase price of $102,500, cash on cash return of 5.8%, cash flow before taxes about $1,800, cap rate 5.9%, and then net operating income of $6,000.
And for all of these examples, are these all assuming a 25% down payment, do you know?
25% for the condo, and then 20% for the townhome and detached single family.
Okay.
Yep.
Great. So the condo is going to be the lowest priced asset you can buy. So, $102,000 purchase price, so $25,000 down payment. So all in for $30,000 with some closing costs?
Mm-hmm. Yep.
Okay.
So we're all in for about $31,000. And then we have a townhome example as well, all in for about $57,000. Purchase price of $230K, cash on cash 4.2%, cash flow before taxes about $2,400, cap rate 5.4%, and net operating income of about $12,500. And then going into single family rental, as you can tell, this was a little bit dated of an example because I have yet to see a single family home in the last couple months, 2-3 months at this price point. It's been kind of wild. So cash on cash 2.1%, purchase price $220. I think I might have skipped over that.
So $220 times 20%, you'll be all in for what, $50,000?
Yep, 56.
Okay, $56,000, 20% down payment. 2.1% cash on cash, $100 a month in cash flow, and a 5% cap rate, and $11,000 in NOI.
Yep.
So, those are still, I know they're not what we saw a year or two ago, but the cap rates are still higher than the interest rates, which is one of those important things.
Exactly. And I think it's just kind of interesting to take a look at these three examples from kind of a zoomed out perspective. Condos and townhomes, they're seeing a little bit less appreciation in comparison to the single family rentals, but we're talking in the teens for both of them, so it's all relative at that point. And then of course with your single family rental, you're going to have a little bit more autonomy as you manage this property, because you're not going to have an HOA. So some people like HOAs, some people don't. I think it's just kind of important to show all different types of options for investors.
You got a thought on this, Jenny? Because this is something I often talk about with people and say, I don't know the answer, but here's just, me thinking out loud with you is,
Sure.
Detached homes a lot of times do have, historically better appreciation. Mm-hmm. But then you look at some condos and townhomes and they're, quite a bit less expensive.
Mm-hmm.
And, the other part of my brain says, hey, since this is such a lower price point, that becomes a more affordable area. Hey, a 3-bedroom, 2-bathroom condo, while it might not be as desirable as a 3-bedroom, 2-bathroom detached home,
mm-hmm.
Hey, a family can afford that condo for $100,000, $200,000 less. Is that going to drive up those lower end condos at a faster clip?
That's a really good question, and as you said, I don't know.
Yeah,
but
it's something I'm always curious about. I don't know.
I think it is a really good question because we have focused on purchasing smaller single family homes, and those have seen the biggest swing in comparison to the rest of Colorado Springs. And I know Lon puts out a really good chart in regards to appreciation by square footage, basically segmented square footage properties. And the smaller ones saw the biggest swing because they're kind of getting pushed up along with the rest of the economy. So I would imagine that probably is true, but not sure.
I think also a lot of the homes you've bought, they've been around or below like the median price point, right?
Mm-hmm.
I always think that's also a good strategy. If you're around or below the median price point, that I think gives you better opportunity and just lowers your downside.
Yep, I agree with that. So just in summary that I've provided, I still think that it's a good opportunity for investors to purchase buy and holds. I think that the longer you wait to buy, if we're still seeing the same trajectory of rent rates and purchase price rates, in a few years from now, you might have missed the boat on that. So I think that it is important to consider purchasing sooner rather than later, assuming that the trends continue, which I believe that they probably will. I don't think that the appreciation rate on the sales price will continue at the same massive rate, which is just crazy, but I still think that it will outpace the rental increase.
Yeah, I think it will just accelerate and appreciate not as quickly.
Yes.
But it's not sustainable like this for the long run.
Exactly. Yeah. Because I didn't project out, but I would imagine if, 20% basically year after year, at what point are you basically at $500,000 for average? And that's just not affordable. So exactly. All right. So going into multifamily rental space, for purposes of this section, we're considering multifamily homes between 2 and 4 units. So we're still on the residential side of things, but more than a single family home. So as we mentioned previously, the overall vacancy rates for apartments is at 0 for buildings of 0 to 8 units. So I think that's still pretty interesting to see. And then something that we've looked at as well, this is data from Your Castle, is that Q3 of last year compared to Q3 of the year prior, there's a 7% average price per unit that experienced the increase. So as you can see from this trend, over the past couple of years, the price per unit has more than doubled since 2015, which is kind of wild because you figure if you have a fourplex and if the price per unit doubles, then you have 4 times that doubled value. So you're able to scale in value pretty quickly when you have more than 1 unit, which is kind of a cool component to this.
And I think for multifamilies, from the data you see down there, do rents and values generally pace each other a little bit better than the single family areas, or do you have enough data to segment those?
I don't have enough hard data, but anecdotally and observationally, I have been seeing some really horrible returns on fourplexes that have been listed over the past month. I think I've only seen a couple be listed anyways. And they were listed at a pro forma price opposed to an as-is price or as-is performance.
So explain that and horrible, like you said. What's horrible about it? Because this is, you caught my attention there.
Okay, so yeah, I was looking at one property for some clients that it was, I think it was, what was it, 1% cash on cash as is for a fourplex, which to me is just kind of wild because you're buying it for the whole intent of being, able to rent it.
And there was there valued upside. Hey, go in there and
there
turn
was.
Units. And
yeah.
So what was? Because I mean, what was? Do you remember like what? Because for those types of properties, I'm less concerned about like the buy side numbers, but did like the pro forma numbers of rehab and rent bumps? What were those like?
So we could very liberally get it to about a 3% cash on cash and a 5 cap.
Okay.
So to me, that's not a huge upside for the amount of work that you're going to have to go in. Well, that's just my personal opinion, but buyers felt the same way. So yeah, it's just interesting. I think that I don't know if it's just people want a property to park their cash, or take advantage of the low interest rates that we're currently experiencing, and no one is selling their multiplexes. Is kind of fascinating. I'm on there every day. I have a buyer that's been looking for a fourplex, and I'm on there every day, and there's just nothing on there. It's wild. So if you have a fourplex, you're probably sitting on quite a bit of buyer demand down there. So months of inventory, kind of the same old story here. Duplex, there was only 4 active listings on October 6th of 2020, 0.7 months of inventory for that. There was 4 fourplexes, which is also 0.7 months of inventory. And I think that is important to highlight that in Colorado Springs, we mostly only see duplexes and fourplexes in terms of multifamily. Don't really see too many triplexes. There's some downtown, but or converted, but they're kind of rare. So going into a duplex example, just kind of running through some of the cursory numbers, using 25% as the down payment, purchase price of $450. We're all in for $132,000.
And since there's no initial repair cost, I assume this is a pretty turnkey property.
It was turnkey. Mm-hmm. And then it was renting out for $1,500 a side. It was on the west side, which I know I've mentioned before is pretty desirable to tenants. They really like it just due to the proximity of some of the nature out there. And just kind of scrolling through that, we're looking at a 4.5 cash on cash and a 5.5 cap rate, which is pretty good.
Yeah.
I would take that. Yeah.
And since you even put this together, I mean, cap rates, have they compressed more than that?
Yeah.
Yeah.
Mm-hmm.
I feel like in the book when it's published, we'll have to put some notice on there.
Yeah.
But yeah.
With every month that passes, So this is an example of a fourplex. Purchase price $550. I'm like, oh, wow, that was really good. This is a couple months ago.
And again, a pretty turnkey product?
Yes. Mm-hmm. And then central part of town, we're looking at about $4,100 in rent for all the units. Accounting for all your expenses and contingencies, we're at 5.6% cash on cash, 5.7 cap rate. And as I mentioned, over the past couple months, we're looking at about a 5% cap pro forma. So that's just how tight things have gotten in this space. So it's pretty wild. And then just comparing the example between duplex and fourplex, I did break out price per unit for each of these, cash on cash return, cap rate. So it was interesting that for a cap rate perspective, they're pretty similar to one another. So
are you surprised by that for like a duplex and a fourplex? So that doesn't surprise me.
Oh, really?
Yeah.
Interesting.
Why does that surprise? Like,
I don't know, because you think about economies of scale. So I would think, I don't know, just that fourplex would have a significantly higher cap rate. You would think, right? No?
Yeah, see, I don't think so, because I mean, because at least, a lot of times, duplex is often very popular with house hackers, so those get bid up a lot more. And at least now what we're having in Denver is a lot of the triplexes and fourplexes won't pass like the FHA's self-sufficiency test rule.
Okay.
I don't know if you guys are bumping up down there in Colorado Springs yet, but we've hit a few brick walls on there, and it's kind of like, we're just gonna not go there anymore. So I'm not surprised that the cap rates, because since those can both be owner occupied, I've always viewed those should be pretty similar.
Okay. Yeah. Interesting.
Yeah.
I would say now, just based on observation, duplexes are a better option than fourplexes, just because there's slightly more duplexes on the market than there are fourplexes. The fourplexes get bid up pretty quickly. So just kind of summarizing that, multifamilies do on average have a slightly better return than single family rentals. And again, it's really what the investor is looking for. I know we just had a really good conversation with Rob Lynn, the property manager over at Milestone, and we were talking about some of the differences between managing a single family home and managing a multifamily. And, there's a little bit more work on the owner or the property manager to take care of some of those shared expenses like lawn, snow, that sort of thing on a multifamily, whereas on a single family, the tenant's responsible for that. So it's really just preference, in my opinion. I don't think there's a right or a wrong option here. They're both good options for sure. Well, then, of course, I guess one thing to highlight is that in the low interest rate times that we're in, I think that is contributing to the demand for multifamily, because you're able to leverage more at that low rate. So I think that's really important to highlight.
So now we're moving on to burring.
Yes.
In the Springs. Now you did a really great in-depth podcast, I guess a couple months ago now, which definitely we'll link to. Definitely listen to that. First off, BRRRR is buy, rehab, rent, refinance, repeat. And that's a term I believe Bigger Pockets, they get credit for making it very popular and giving a cool name for there. But so many people, that's what they want to do.
Yeah.
Because it sounds amazing to go on there, buy a property, go recycle your capital, and just do it again and again and again, and be able to build a property very quickly.
Yep.
So on paper, that sounds good. And then reality smacks them?
In Colorado Springs, yes, I would say so. I'm a huge proponent of BRRRR. I mean, it's an incredible strategy when you think about it. I've done 8 in Colorado Springs over the past couple of years. So I think that it's been really interesting looking from when we first started it to I know a couple of people have probably heard, my accidental BRRRR story, to when it was more meaningful. And then as time went on, when I was purposefully trying to BRRRR properties, I noticed that margins were getting tighter and tighter and tighter and tighter. And we would go from being able to cash out refinance pretty much everything that we put in to only part of it. So just seeing that trend to where we are right now, I mean, I don't think that BRRRR is a reasonable expectation to have in Colorado Springs for just your typical investor like you or me. You would have to be a full-time acquisitions mode to really get a property that is BRRRable, in my opinion, right now.
When you say full-time acquisitions mode, paint me a picture on that. What do you mean?
Door knocking.
Like I just call you and you find me, right?
Sure. No, that's definitely not good. So I mean, honestly, people who have direct mail set up, door knocking, calling people, I don't even really know. I don't.
They have a lead generation business to find motivated sellers.
Yes.
And,
and that is a full-time job.
Well, so it's a full-time business with
exactly
overhead, with a comma or two in there, and usually a couple employees.
Exactly. So because I'm not in that realm, I'm not acquiring properties anymore at that level. I think my time is probably better used doing my job where I'm at right now, to earn income to then buy properties, I think.
And I think that's a great analogy for everyone out there listening to as well, since a lot of our clients, they are not, full-time investors where they've got acquisitions teams and businesses, but hey, they've got their job, they've got their business or whatever, and they're still going to buy properties for, more retirement planning standpoint.
Mm-hmm.
And it's a great question to always ask yourself out there as investors, hey, can you BRRRR? Absolutely you can. But what does it take to get those properties in terms of time and expense?
Mm-hmm.
And for a lot of people, it just becomes a lot of time, a lot of expense where it's like, hey, is that worth it for me to do it? If your time is worth, X amount per hours at your job or your business, you have to evaluate that and then have a realistic conversation. Hey, if you want to go out there and go into acquisition mode, you're going to have to go out there and start a business and take those risks. And hopefully you get that reward within the next couple of years.
Mm-hmm.
And this kind of comes down to just, I agree with the BRRRR, one of the best strategies out there.
Mm-hmm.
The problem is it doesn't work in our super low inventory market conditions. And that's where, great, I want to BRRRR. I'm not going to change the market so I can BRRRR, but I can change my strategy to go with the market.
Exactly.
And that's a really important point I think people need to understand and digest.
Yeah. And something to piggyback off of that, I know you and I have had a couple conversations about this. How long is it going to take if I start today and I'm going to find the perfect BRRRR opportunity in Colorado Springs, how long is that going to take me? Is it going to take me a year to pull out $50,000 in cash, in my cash out refinance? Or could I have just worked for that year and earned $50,000 that I can then put down on a property as well? So it's just kind of considering those options. So just kind of going into, we'll skip over some of the examples because, as Chris mentioned, we have a really in-depth podcast that's linked in the show notes for this.
But I think that high-level strategy, that's the punchline right there.
Mm-hmm.
That's the important thing to know about BRRRRing right now.
Yeah. So kind of jumping to my personal opinion on the current state of BRRRR in Colorado Springs. So as we've highlighted, the market has gotten really tight over the past couple of years. You could go from full BRRRR years ago to a very partial BRRRR to it's pretty much very difficult to find it at this point in the market. And so, I'm taking to the slow burn strategy, which is just, I wanted to make up my own acronym too because everyone else is doing it. So buy, renovate, rent almost immediately, and then sit and wait for the last 2 R's, which is refinance and repeat. So
it should be BRRRR, right? Buy, rehab, rent, patience. I think patience is such an underrated virtue right now. Then refinance, then repeat.
I like that.
We can trademark that together.
Okay, sounds good. So just basically the idea that if you bought a property in Colorado Springs today, 2 years ago, 2 years from now, whatever, based on the trajectory that we're looking at, and let me caveat this because I know I just want to make this abundantly clear. It needs to be cash flowing now, and it needs to be cash flowing after you BRRRR it. It needs to have that cushion for sure. So this is not 100% appreciation play. So just making that clear for everybody. But if you bought that property and just sat and waited and managed it effectively and efficiently and just went about your life, in a few years from now, you're going to have enough equity just from market appreciation to then consider pulling some of that out and redeploying it for towards another asset to perform as well on that one additionally. So here's my little warning. The investor must make sure that the properties are cash flowing both before and after the slow burn.
And the thing is, it's hard to know if it's going to cash flow after.
Mm-hmm.
But if it doesn't cash flow, what that means is the market gave you a tremendous return on appreciation.
Mm-hmm.
Great. What's the other door to go through? You sell your 1031 into a better rental property.
Yep.
And so don't worry about the future cash flow because, if you want to refinance, it has to make sense in that. But if it doesn't, hey, sell and trade up.
it's a really good problem to think through.
Oh, yes.
Yeah.
And that's definitely something, you and I do a lot with clients with like, the return equity spreadsheet we have. That's something that we've put a lot of time into and specialize and say, cool, here's the options. Keep it, refinance it, or sell it and trade up. And we help you understand that too, because this is a great problem. We want you to help facilitate in a couple of years. We can have that conversation with.
Exactly. So just to kind of give an example, I know I've talked about taking some of our properties that we had bird previously years ago, and then they appreciated quite a bit. So, for example, I had done a full burr. I think I had, I don't know, $5,000 left in it or something like that. So we had a $131,000 loan, and then that property was appraised at $230,000, which is funny reading this now because a comparable property just sold for like $270,000 over the last couple of months. So, and then just using 75% loan to value requirements, we could take out another loan of $172,000 utilizing a cash out refinance. So we're taking home another $41,000. So if we had originally pulled out $40,000 during that original cash out, and then we took another $41,000, so we have basically negative cash in the property, which is amazing. And it's still cash flowing today. So very happy with kind of how that works out. And then, so what did we do to the property since the first time we bird it? Nothing. We just managed it well, put good tenants in there, and just let it sit for 3 years.
You were patient.
Yeah. And then I know you haven't heard this quote until recently, but I like it. It says, "Don't wait to buy real estate and wait." So I think that this really sums up what we're doing with that. So just being able to use that cash out that we did, we can put that on a different property.
I like that quote.
Yeah.
Is that yours or is that?
No.
Okay.
I can't take credit for it. I don't know who said it though.
Okay.
So just putting 25% down on a couple rent ready properties. We cash out refinanced 3 properties that we had previously bird, and we're able to buy 2 properties, 3 units with those proceeds. So, and everything is cash flowing right now. So even though we have a little bit more tied up in debt, we were able to take a cash flowing asset, redeploy the equity into another cash flowing asset. So now I have even more cash flow. So that's kind of the power of that. So just kind of going into some of the risks of the strategy, don't rely on appreciation. If this technique works out, great. If it doesn't, okay, well, you still have a cash flowing property that, yeah, you might have some cash that's stuck in it. You might have some equity that you were hoping to get, but you can't quite pull out yet. Maybe just wait a few more years. Either way, if you bought it right today, you won't have too many issues in a couple of years from now. And then
the other, I mean, like risk assumption on there is, what about interest rate risk?
Yeah, so that's a really good one. So we are in a very low interest rate environment right now. I don't know what the interest rate's going to be in 2-3 years from now. It might not be worth refinancing.
Probably higher if I had to take a guess. My guess would be higher than lower.
Exactly. So if we're at 3.5 now and we're at 5 2 years from now, it might not make sense to do that. And then, as Chris said, maybe that's when you evaluate doing a 1031, doing some other option to it.
Or you do some seller financing and sell it that way.
Yeah.
And that's the thing I want to highlight. Again, you Jenny did a great job. You buy a property that makes sense today in the current market conditions and for your returns. And then we have our projections for 3 to 5 years out. Mm-hmm. But those are projections, and they don't always go the way we project, and a lot of times they don't. Mm-hmm. Then you have different options on there. Hey, you just hold it and keep it, or you refinance it, or you sell and trade up, or hey, interest rates go up, you sell it and you do seller financing, and then you go that way. There's always options. That's what we want to stress is there's always options, as long as your property makes sense today, mm-hmm. and you can hold on to it, which I think leads into one of the next subjects of your reserves.
Exactly. Yep. So I won't get too into the LTV requirement that I am self-imposed. We'll go into that in another section. But just kind of going over the burr versus the slow burn. As I mentioned, nothing's going to beat the burr strategy, in my opinion. It's just the king of real estate strategies. And, but I think that you need to kind of adjust for market conditions. So if you think about a bell curve, what is the highest probability of success? Somewhere right in that middle point. There are opportunities for burr, but that's in the shallow part of that curve. So just aim for something in the middle. Don't shoot for that home run, shoot for a base hit. So, and then you often kind of hear saying putting 20% down on a property is not good investing. I love burr, but it's just not realistic today to do that. And I see nothing wrong with putting 20% down on a property. It's still investing. And you're still going to reap all the benefits of a real estate investment. So just, kind of considering that. And then just based on what Chris and I were saying earlier, if you wait a year to find that perfect burr property, well, prices have gone up and you've missed out on opportunity costs. If you buy something that performs well today, instead of waiting that year, you've missed out on a ton of opportunity. So I think that's also something to consider as well.
So again, for the reserves and contingencies, you did an in-depth podcast on here. So we'll link to that, or just go through the history, and that's the title of the podcast, I think, as well. But give us just the really high level, quick executive summary for what, if I'm buying a property, where I'm putting, hey, it's $100,000 down to close on the property. How much money should I have in the bank for reserves and contingencies?
Okay, so I am very kind of a stickler for this. So I will be a little preachy about it, but there's 3 layers of things that you need to consider. So one is vacancy. How low can you make your rent go to avoid a vacancy? Because the vacancy is what is paying for your operating expenses. If that layer gets unraveled, you need to have 6 months of contingency funds in your bank account per property. I'm pretty steadfast on holding to that. And then if that layer gets unraveled, the last thing you need is equity. If you're kind of waving the, white flag at that point, if you had to liquidate your real estate holdings, you're in a state of dire emergency. If you have equity, that will save you from having to bring money to the table.
And you can sell and walk without a short sale or foreclosure, again, writing the $5,000, $10,000, $30,000 check.
Exactly. That you presumably don't have since you've exhausted your reserves. So
yeah, I think the way you layered out was very good. So I would definitely recommend listen to that podcast in depth and also read the chapter, because it's a very good strategy. It's not sexy, but it's one of those things where that's what allows you to stay in the game, but mitigate any downside risk from personal stuff, market stuff, property issues, anything like that. So I love the way you outlined this with those three tiers, for lack of a better word.
All right, this is a pretty quick section right here. Fix and flip and fix and list in Colorado Springs. The short answer for fix and flip is we can't help you. So we've already mentioned that inventory is extremely tight. I think in order to be a successful flipper, that is your job. You have to have marketing. You have to have crews. You have to have funding. That is your full-time job. So.
And you have to act usually very quickly within a couple of days.
But I do think that the fix and list strategy, and there's nothing different between fix and list in Colorado Springs versus in Denver. In my opinion, it's just different markets. But that strategy, and I know you and Lauren have a pretty detailed guide on that, so I won't go into it too much, but it's just an interesting way to take advantage of the appreciation that we've seen. And it's beneficial from the standpoint in that if you're able to take advantage of the appreciation that we've seen, and then the seller has own their home for a number of years, you can take advantage of Section 121 exclusion. So for the gain of the sale of your principal residence. So I think that's kind of interesting concept to be able to marry the two strategies together. I know a lot of people do live in flips, but this is probably more so if you want to just kind of move into a different property, is probably less purposeful, but is still a really good option for people.
See, I go more. I think this is where our strategies differ a little bit, Jenny, because I'm a lot more like on like the slow burn.
Mm-hmm.
I see like doing that. Hey, you buy a property, it makes a good rental today.
Yeah.
Give it 3, 5, 7 years as that it pops, it appreciates, all that stuff. I think that's a great opportunity to go on there and then do a fix and list on that 3, 5, 7 year time frame.
Oh, okay.
Go in there and do a delayed flip, for a lack of better words.
Okay.
And then, because you always get top dollar by selling a finished product to an owner-occupied buyer.
Yeah.
You know, which is not us. We're not investors, but hey, flip, hey, they got their job, they got their family, they just want to buy a place in their school district that works for their commute and be done with it.
Mm-hmm.
Flip that property and then maximize your proceeds, and then 1031 another property. And of course, depending on the property location, depends. Hey, it might just be a light cosmetic update. Hey, paint, carpet, some new flooring, refresh in the kitchen. Or it might be a full, $30,000, $40,000, $50,000 job. But that's something where, as your property grows, like we can help you identify, hey, what's that sweet spot for, hey, if you invest $1, we hopefully get $3 back on the sale proceeds.
Yeah, that's really interesting. I guess I hadn't considered applying it to a rental property
really?
For a slow flip. No, because we had a client in Colorado Springs that the family had lived there for 7 years, and they wanted to move into a nomad property. And so we did the fix and list strategy. So now they've made quite a bit of gain, but now they don't have to pay taxes on it because they lived there for 2 of the last 5 years. So interesting approach to look at it both ways as an option.
But just another option to keep on there.
Yeah.
Because I've had clients ask me, they're house hack or nomading, where should I stay here for 2 years to take care of that exclusion? And my advice is like, no, go in there and buy multiple properties, and then 1031 it in 5 years rather than staying there 2 years so you can accumulate more.
Yeah, that's really cool. Yeah, they were able to cash out. They bought a nomad, and now they have enough for probably 1 or 2 more single family home purchases. So that's kind of how they structured it. So that's what I love about real estate, is that there's so many different ways that you can strategize and just see what works best for the situation and for the market conditions. So that's awesome. So just kind of went through an example on that. So you guys can read that in the book. And then house hacking in Colorado Springs. We have a podcast dedicated to this as well. We'll link to that in the show notes. But kind of the synopsis of that is Colorado Springs offers really good house hacking options for investors. I think that depending on maybe where in the city you want to live or what strategy you want to implement will kind of help steer either way for that.
Yeah. And I mean, that's something I would say definitely listen to that podcast. And I know there's some things too, about certain areas based on the way the houses were built and zoning codes, or sometimes you can split the house up, and there's some really good opportunities to almost make an up-down duplex.
Yep.
And also some areas that make a lot of sense for like room-by-room rentals. So if you guys are house hacking, reach out to Jenny down there, because she knows all those nuances.
Yeah, so it's definitely a really good opportunity, and same concept as up in Denver. House hacking is an awesome way to get into real estate investing.
Yeah, I tell everyone, if you're in a position in your life where you can go in there, whether it's nomad or house hack, if you're in a position where you can, just based on your lifestyle, hey, moving in and moving out a few times, do it. It is the best use of your capital because you get such high leverage. Like the long-term effects of it are amazing. So, all right, Jenny, well, this is great. Any final thoughts before we wrap up here? Because, I mean, this was very detailed. People can always check out the show notes. They can always reach out to you to help figure out where the market is currently, and then also match it to their goals and their current personal financial situation as well. So they can fill out the form on the website, or just email Jenny, Jenny, at envisionrea.com, right?
Yep, exactly.
Jenny, this is great. Thank you so much.
Thank you.